Welcome to Ahead of the Curve. Subscribe now.
Will the Fed save the markets, guys? Welcome to Ahead of the Curve 1776. It is I, Mr. Curve. Hope you guys are having a fantastic evening. Man, stuff is just deteriorating rapidly, guys. So many different things are happening. Markets are kind of going haywire. There's tons of turmoil in the markets. We're going to discuss it all in this video today. If you're new to the channel, we talk about everything from economic data, monetary policy, politics, market, and trading strategies. So let's get to the money and let's get to the markets. Check out my videos here, guys. Please look at those. Also, check out the featured channels as well. And also hit the links at the top to get yourselves involved in the game. Please watch the video in its entirety. And please like, comment, share, and subscribe. So let's get to it. So this morning with trading, guys, it was absolutely nuts. I woke up, obviously, like most traders do, about 6:30, 7 o'clock, getting myself abreast of what's going on in the Europe session. Europe session had tons of rollover. Credit Suisse, as you already know, had a situation going on there. Basically, their investor wasn't going to give them any more funds. So we are definitely in the midst of a liquidity crisis, guys. i.e. 08, 09. So definitely be mindful of that. I did express that on several videos, guys, but now it's more paramount than ever that you really keep cash on hand and make sure that you're utilizing the 4 pillars of the trade very, very close to the vest. So as we've seen today, guys, I'll go over the economic data here. We basically had CPI and PPI come out. I'm sorry, CPI for yesterday, which I did a video a couple days ago, so we kind of missed that one. So CPI came right in line, and also core was a little bit higher, but 6% on the year-over-year CPI isn't horrible for our purchasing power. It is, but as far as what the rates look like going forward, we're already inverted on the yield curve. So honestly, we're kind of at the end of the rope. The 25 basis point rate hike will probably be moot at best. It probably won't mean anything. Either way, I don't think anybody in this market is viewing anything the Federal Reserve does as a dovish, as a hawkish state. I don't think anybody is going to anticipate some type of hawkish left field, stance going on. Even if they come out and hike rates 50 basis points and came out and jawbone and said that, hey, we're still gonna be removing liquidity. We're still going to. I don't think the market's gonna buy it, guys. I really don't. And then the press conference will also be a lot of Q&As with that sentiment as well. So I don't think it's going to happen. We had the CPI on Tuesday, PPI, and then core PPI on Wednesday here, which basically came right in line. Now, one thing I will say, these retail sales here, I mean, they definitely shrunk there. As you can see, spot 4, negative spot 4, and then last month it was spot 3, so a little bit of after effects of the holidays. But I mean, we're pretty much at this recessionary point, guys. I don't really see it not being a recession going forward. The Fed literally went up several basis points, several percentage points over the last year. Eight rate hikes, including next week will be 9. I just don't see it going any further. I did tell you guys I didn't think the terminal rate would be 6%. I thought it would be a little bit lower, just due to the fact of where they were last time, 5.25. So we're definitely probably seeing it pull back from that point. Also, guys, let's get you guys over to how the Forex market did for today. Again, Forex trades trillions of dollars per day. The stock market is a drop in the bucket compared to Forex. A lot of people that I know do trade it, so it definitely is a key option for a lot of people. But basically, I'll give you guys a rundown on the euro/US dollar, the most liquid currency traded pair in the world. So basically, we did have a sell-off, or the dollar getting stronger essentially overnight, which I thought that was going to play out a little bit further, but then we had a slight reversal at about 10, 11 o'clock, and then we did kind of move upward there after people digested those PPI numbers as being worse than expected. Better than expected, truthfully, and then also the retail sales being worse than expected, because in a lot of people's eyes, you guys got to view it from a trader's perspective, is where does rates go in the future? That's all traders care about. They're trying to predict the next rate increase, the next rate pause, the next rate cut. They're trying to predict that, and that's what leads them to believe maybe a stock will go up, maybe a certain currency will depreciate, maybe a certain commodity will go up, maybe a certain option will go up, maybe the dollar index if they trade that as well, or an index. So that is what a lot of traders are looking at, investors/traders as well too. So basically, we got this weakening happen here. We go out on a dollar. I will tell you, I'm definitely thinking that we're going to pull back up, like I said, back to that 107 mark, even with a strikingly hawkish statement as well as press conference. I'm still thinking we're going to move a little bit higher, guys, because the jig is up. If they continue to increase these rates, these bond conversions will basically be sold off less at a discount, which means that they're going to run out of liquidity. So in layman's terms, guys, they are going to run out of liquidity if the Fed doesn't do some type of stealth QE, quantitative easing. They could, though. Honestly, the Fed could do whatever they want. They could raise rates. They could come in and be like, hey, guess what? We're still taking this stance as an interest rate point, but we're going to go on the back end and then just liquefy everybody. So we'll have to wait and see. But more importantly, we'll have to wait and see how the markets perceive what's going to happen, because that's going to be key, guys. All right, so let's go ahead and we'll probably run over the rest of the economic data on my Saturday or Sunday video, but let's go ahead and get you guys over to the metals market. Let's see what happened over there. Metals was quite mysterious how it traded today, guys. With the whole Credit Suisse situation happening and a few other bank sell-off, the banking sector as a whole just completely sold off today. I did bring some of the guys back a little bit, but overall, guys, there is contagion fears in the markets right now. And then we're just going to look at gold here. So gold basically for the day kind of shot up a little bit here. I'm actually shocked because WTI pulled back tremendously. And again, guys, these all are priced in US dollars, so you got to be mindful of that. But where I see gold going, next stop maybe 1950, guys. I mean, probably that 2,000 mark. I mean, if we're at this current pace, we're jumping up basically $20 per day from what it kind of feels like. So maybe 1950, maybe 2000, by that press conference or by that release of the interest rate. And again, it is a 2-day meeting. It starts Tuesday. It's released on Wednesday. So we'll definitely check that out as well, and we'll see what's that. Let's also check on the news here. U.S. Treasury Department viewing U.S. bank exposure. So they're just going to be viewing a lot of exposure, guys. They're going to be looking and seeing what if there's anything else that could be happening. Also, I read an article from the Federal Reserve this morning. Fed Now will be launched as of July, and that's going to be huge, guys. It's going to be basically an instant payment system. So in a lot of ways, it still will be similar to like ACH or wiring, but it won't be running off a blockchain. It will essentially just be a payment system. So if I had to guess, maybe similar to a Zelle. I mean, if I had to put it in layman's, probably similar to a Zelle or Venmo or something along Cash App, something along those sorts. But it will be the Federal Reserve that's hosting it. So a lot of big players will be involved in that, not just small, mom and pop situations. So we'll see how that develops. That will also probably help with the liquidity situation, so that way they can get liquidity to certain institutions very quickly compared to before, because they're always on the back end with this stuff, guys. I think they're one to be more real-time proactive in how things take place, especially with the exacerbation of the credit issue over the last few days. Let's get you guys now over. Actually, let's go back to the markets here. I kind of want to show you guys real quick. So we'll just check it out. And basically, silver had a little bit of run up to pull back, almost got to that 22 mark. And then as you guys can see here, the Dow versus the gold. Gold's pushing up a little bit for today. BTC, gold is losing a little bit of its hair on that. So all in all, guys, right now these are very turbulent markets. Again, when that VIX, the VIX is over 20, you're going to see a lot of volatility. Let's get you guys now over to the energies market and let's see what occurred there. Kind of just want to show you guys this WTI pushing down significantly this morning. It was definitely a lot of my indicators and my Fibonacci sequences were definitely saying that this is a strong sell. So I definitely got in here, got a couple of points off of this guy, made a little bit of money. But again, guys, you have to be keen in on these type of situations. You have to be watching all situations, just to make sure that you're abreast of what's going on. If you're a trader like me, institutional, whatever the situation is, you have to be mindful and paying attention, because just because you trade one particular stock or a meme stock, you still need to be seeing what the other markets are doing in real time to know whether you're staying ahead of the curve. So let's go ahead and check out the other markets as well too. Let's check out Brent and let's check out natural gas. So we're having a little bit of a push up in the early Asian session for tonight here. Pushing up a little bit, heating the gas, gasoline 266. Now, I will tell you, the WTI being under 70 is a huge psychological situation. That might also encourage the Fed to pivot, or they may look to that as a deflationary factor for a lot of people, just due to the fact that they exclude it out of, core CPI. So the fact that that's pushing down, that could also help the Fed. And I want to also give you guys a little bit of take. What if the lapse of liquidity is purposeful? What if it is? What if people not having so many dollars is purposeful on the Fed's part? It's very well possible. I mean, you could definitely see that would remove a lot of liquidity. Hence, 0809. That's pretty much what happened. A lot of liquidity evaporated. All the housing liquidity evaporated. certain things like that, the big run up. So it's, stocks, liquidity evaporated. People weren't able to sell those shares at higher prices. They kind of took haircuts on that. Portfolios took haircuts. So we could definitely see that occur, guys. Again, it's kind of like a merry-go-round, but you got to get off before the music stops. So basically, let's get you guys over to the cryptos market. Let's see what happened there. Now, I'm not going to lie, guys, you got to diversify a little bit because, with this banking crisis, you never know what might actually happen. So you definitely got to be mindful of every type of way you can transact. So, if you guys can see here, Bitcoin definitely shot up. Again, you guys already know the market share. It holds 90% of the market share as far as the actual coins there, as far as dollars into those coins. So essentially that did push up over the last couple of days here, which is paramount because a lot of people obviously ran it up. They were taking some other form of of paper. So, maybe they moved some money out of their bank, put it into BTC in a cold storage wallet. It's very well possible. You never know nowadays, guys. You just want to be able to have access to a little bit of yours, because I will tell you, due to the Dodd-Frank Act, I think it was 2009, 2010, basically the banks can bail your money in, and you'll be a creditor to them, and then they'll just owe you. And then, obviously FDIC will come in, there'll be a receivership situation, so then, so on and so forth. But you got to be mindful of the situation. Look at this here, U.S. Treasury Department reviewing U.S. banks' exposure to Credit Suisse. So we got to watch out, guys, a lot going on. I will tell you, this liquidity crisis has affected my trading. I'm not able to get in as soon as I'd like to, not able to get out. Trend lines aren't as consistent as they should be. So over the last 3 trading days here, I've had a little bit of a struggle, I'm not going to lie. Lost a little bit of money. But that's just the name of the game. Hopefully we can get that VIX under 20. Hopefully we can get the Fed to kind of step in and jawbone quite a lot, provide liquidity, liquefy the banks, kind of calm the seas down, because they're definitely rocking the boat right now. Let's get you guys now over to the dollar index. I want to talk about a few things there. Dollar index, guys, 104.74. I mean, this thing literally ran up on me today. I had a trade against the dollar index, and this guy literally kept running up on me. It definitely was driving me nuts. Shot all the way up here from 103 area earlier this morning. It had that big push during the Euro session, early Euro session, Asian/Euro session, and then it just ran up, guys. Once that Credit Suisse situation happened, risk off, inversion happened, and basically everybody piled into the dollar for safe haven. Then we started to see, surprisingly, we didn't see the bonds actually push up once people ran into the dollar, the yield on the bonds. We basically seen them come down because we kind of have a tandem effect happen. We have people running to the dollars as far as safe haven, and we have people betting against the dollar due to what will happen in the future. So these things are interconnected, okay? So you just got to be able to weed those out and determine where you need to be. Let's get you guys now over to the stock market. So it looks like futures are up here, but the U.S. market, let's go for the Euro session. So Euro basically ended the day very down. I mean, they were pretty much down, but of course the old nifty Fed here, pulled back some of these markets quite a bit. These were down significantly. I mean, I think the Dow was down maybe about 750 on intraday as far as the trading time. But basically the VIX is still above that 26, very volatile. And then we're going to check out those bonds here, guys, and pretty much the bonds tell the story as to where things go for the future. So we'll just come in here. Essentially, we have a pure inverted yield curve. I mean, typically as you go further out, the yield should be better because you're taking more risk. You're getting more time. There's longer time for you to get your principal back. Yada yada. So essentially, these should be higher. So basically, I mean, these are almost projections of what will happen, give or take. Keen on the give or take. So basically, within 3 months, they're expecting. Maybe there is a 25 basis point hike, but as we started to come along here, I mean, these are telegraphing essentially, some rate cuts. And again, that's going to be inflationary regardless of what percentage. At this point, guys, we have so much debt. I don't think the actual percentage raise basis is going to affect anything long term. What it's going to give off is the impression. The impression is going to be worth more than the actual action itself, because it will telegraph whether the Fed is out of tools, whether we are MMT to infinity, which most likely that's going to be the case. That's what happened since 1913, since the inception. That's what happens. I mean, we have been QE to infinity this whole time. They just been give or take, slowing it down, speeding it up. But in essence, that's pretty much what happened, and definitely since 1971. So basically, guys, we're going to be pushing up. And what does this mean for you? You guys always know I'm always keen on what does that mean for the day trader, the investor, whoever, right? The mom and pop who just wants to know what's going on. That means we're going to be shorting the dollar, because the dollar is going to lose its value, whether people believe it or not. It will. Now, whether we have a very rapid appreciation followed by the depreciation, is very well possible. That's what happened in 08-09. The dollar got extremely strong, and then it just inflated away, and then we basically had a slow period of that. So could it be that way? It definitely could be, especially if we start seeing people, these banking institutions fall off the map. Yes, that means there's going to be less dollars floating in the economy overall. But you guys know who's the backstop, who's the lender of last resort, and that will be the Fed. The Fed will push everything back to where it needs to be. Hence what it did today. So, and again, I love the Fed. A lot of people view them as a bad entity. Of course, your purchasing power is getting harmed. But this is how I make a living. So for me, this is good news. Let's get you guys now over to bar chart. I want to talk about a few things there. So we will focus on the stock market leaders. We had Tesla down a little bit today, Nvidia up a little bit, Microsoft up, Apple obviously up. We had Meta a little bit up. Charles Schwab making a little bit of a comeback, 5% up a little bit. I'm not really sure why people sold off Schwab. I got to read more into that. But basically, they sold that guy out. And then we also had JP Morgan down a little bit, but they're $128 a share, so I'm not really shocked by that. But all in all, guys, we'll have to see how things play out. It's definitely crazy stuff happening day by day. Definitely be mindful when you're in these markets, guys, because you don't want to be caught in a wrong position or a wrong trade. So I'm going to leave it right there, guys. I appreciate you guys joining me. Please watch the videos going forward in its entirety. It definitely does help the channel. Also watch the ads as well. That's what funds the channel. I appreciate you guys. Please like, comment, share, subscribe, and as always, more importantly than ever, in order to be profitable, one must have the knowledge and insight about the next trade or position to. You guys already guessed it. Stay ahead of the curve. I'll see you guys on my next video. Happy trading.